All right, guys. Just a brief, we look at the interest income. You already know this, right? We worked around with this. Um, the nil rate bands available for interest income. We know that 1,500, no nil rate band for additional rate tax, and the initial 5,000 band as well. We worked with this a lot, right? We've looked at several examples. Now, if you look at the last 3 points, it says interest income received from bank and building societies is received gross. That means there is no withholding tax. Withholding tax, as we discussed earlier as well, is also called tax deducted at source. So for example, let's say this is a bank and they give you the interest, okay? Let's say £1,000, okay? You earn £1,000 and you get £1,000, that means there is no withholding tax in this situation. But if you earn £1,000 and 20% of it is taken away at source by the bank, because bank is the source. So if it's taken away by the bank at source, that means £200 is gone. And now what you'll get instead is just £800. This 200 becomes tax deducted at source. It becomes tax which has been withheld by the source, by the bank in this situation. Obviously, like as per the law, bank and building societies, they won't deduct any tax. They'll give you the entire amount. Okay. Interest income received from unlisted companies is received net of 20% withholding tax. So for example, if there was an unlisted company, okay, now again, same example, even though you have earned £1,000, you will get only £800 because 20% will be deducted, right? But in the tax pro forma, you will include the gross amount. In the tax pro forma, the one that we usually use to calculate tax, you will include the gross amount. You will calculate the normal tax, but then when you get your income tax liability, obviously by now we know everything about how to get an income tax liability, right? Whatever income tax liability you have, let's say you've got income tax liability of £10,000, you will deduct a tax credit or withholding tax. That means any tax which has been paid at source already. So £200 technically should be deducted from this because it's a tax that you've already paid. So now your income tax payable, becomes 9,800. All right. So whatever tax you've already paid at source, or it has already been deducted at source, reduces your income tax liability at the end. When you calculate at the year end, when you calculate the income tax liability, it reduces your income tax liability. Okay. Interest received on national savings certificates and individual savings account is exempt. This is something that we looked at earlier as well, when we looked at some exempt incomes, right? Now, coming to the topic of pensions, extremely important. There are a few things that we'll be learning in the pensions topic, so please focus. See, there's one thing we discussed. We said that when we talk about pensions, what exactly that is. When you're earning, when you're young, you're working, you're working hard. And at that time, your brain is highly efficient. You're very smart with making money and all those things. This is the time, because you're young, you have that tendency in you to live the life to its fullest. And people do that, okay? When they're earning so high, they live the life to their fullest, right? So the earning derives the spending. Obviously, the one who's earning less will spend less. And the one who's earning high, is a high earner, will obviously spend more, right? The thing is, the government in the UK is a welfare government, right? It's a welfare state. UK itself is a welfare state. That means if you wouldn't be able to take care of yourself, being a UK national, the government will take care for you. right? So the government will take care of you, and the government will make sure that you get your basic necessities. Okay, but that obviously is a burden on the government. That is a burden on the government. So when you're earning, when you're young, you're running a business, you're doing a job, whatever you get paid, less, high, whatever it is, right? The point is, the government encourages you to save for the time when you'll retire, and you won't have any active income. Okay, so right now, since you have an active income, save a chunk of that income for the future so that you don't become a burden on the government. And that is what pension is. Okay, now one type of contribution is a compulsory contribution that you have to make. If you are self-employed or employed, you have to make that contribution, and that is called NIC, National Insurance Contribution. We'll study the national insurance contribution in the respective topics: employment income and self-employment income. Okay, what we are looking at right now is a private pension contribution. Private pension contribution is not it is a fund. Basically, it's a pension fund which is not managed by the government. Okay, it's managed by the private funds, private entities. Okay, within the pension fund, private pension fund, there are two categories. One is your occupational pension fund, occupational pension fund, and the second one is your personal pension fund. Now, obviously, as the name suggests, occupational pension fund is only when your employer opens up a pension fund in your name. There are employers like this in the world, obviously, who are, multinationals and, big corporations. In fact, I would say smart corporations, they do that to retain employees. They actually go out and they don't just pay the salary. They don't just pay the bonuses and commission. They actually contribute a small chunk, or whatever the amount is, they contribute a percentage towards the retirement of the employee as well, right? So for that, the employer, your employer, where you're employed, basically, they will open up a pension fund in your name, and you and the employer both can contribute in this pension fund. Obviously, occupational pension fund is not valid for someone who is self-employed, who's running a business themselves. It's not valid for them. Yes, it could be valid for their employees. If you're self-employed, if you're a businessman, a businesswoman, right, you can open up a pension fund for your employees. For them, it will be an occupational pension fund, right? But from the perspective of employee, it's valid. Personal pension fund, on the other hand, regardless of whoever you are, an employed individual or a self-employed individual or anyone else running your managing your properties or managing shares or whatever it is, you can go to the pension fund, ask them to open up an account in your name, and they'll do that. Remember, these pension funds are private registered pension funds. They have the license to basically take contributions from the pensioners and invest the money into certain avenues. Obviously, not very high risk avenues, not something like Bitcoin, okay, not something like NFTs, okay, nothing like that, but medium to low risk is the profile of pension funds. And that is where for example, blue chip stocks, right? For example, blue chip stocks are basically dividend paying stocks, right? The stocks which have high potential of capital growth as well as dividend growth, right? So those are called blue chip stocks. So they would probably invest in blue chip stocks or commercial properties to earn rentals from it, or other avenues, for example, fixed income in bonds, right? In AAA rated companies, bonds of AAA rated companies, basically. So that is where these pension funds invest, because obviously they can't take the risk. By the way, from the practical point of view, pension funds in today's world are one of the most highly invested funds within the hedge fund category, right? Hedge fund, by the way, plays a very high risk game. Okay. But they manage their risk by not directly taking the exposure which a hedge fund would take, but they basically invest in a hedge fund, and then the hedge fund takes direct positions in, short position, long position, stocks and bonds, in money market. That's um, a whole different ball game, right? So just for the sake of explanation, you need to understand these pension funds, for their pensioners are basically investors in this case. They invest, they manage the investments, take a fee, and the remaining is allocated to the unit holder, who are basically people like us who invest in the pension fund, who contribute in the pension fund, right? Now, like I said, government promotes it. Why does the government promote? Because they don't want you to be a burden when you retire. Simple as that. Okay. We already discussed the benefits for pension funds, right? And that was mainly for personal pension. Now remember, your employer, as an employee, if your employer opens up a pension fund in your name, that's occupational pension fund. Both you and your employer can contribute in it. If in an individual capacity you want to open up a fund, you'll have to go open up a personal pension fund. Even in that, your employer and yourself can invest, can contribute. Okay. What we need to understand is the benefits we studied earlier when we were studying the income tax computation basically was for personal pension fund. There were three benefits, if you recall: 20% contribution by HMRC, Number two, ANI reduction by gross amount, ANI reduction by gross amount, and number three, okay, band extension by gross amount. This is what we studied. Now, please try to understand the logic I'm going to present, and that's the only possible logic you can have. Okay. See, there are people who are extremely rich. Sorry about this. Yeah. There are people who are extremely rich. For example, there are football players, I'm going to tell you, right? People who, like, these are the guys who are even in the English Premier League, obviously one of the highest paid leagues in the world, right? Extremely rich people. Like, they're earning hundreds and thousands of pounds in just 1 week. And there are 52 weeks in a year. Okay, hundreds and thousands of pounds in just 1 week. The point is, if they start saving for their retirement age. By the way, these football players, obviously they're professional football players. There comes a time, because of their injury or because of the exertion that they do professionally, body can take so much of an effort, right? That it's like the muscles and the bone structure, it gives away, okay, to whatever effort you've put in for the last 10 years, 15 years, right? So the retirement age is very less. Like after the age of 40, you won't be, if you're a goalkeeper, probably you'll be able to play, but even if you're somewhere playing in the outfield, you won't be able to play after that, right? So the point is that these people, I'm talking about the cream, I'm not talking about the ones who don't get paid that much, but yes, generally footballers do get paid a lot if you're a professional one, right? The point is that if they start saving for if they start contributing in the pension fund, I told you this 20% contribution by HMRC is just a hypothetical contribution just to allow a tax benefit, right? But think about it. Imagine how much ANI could they reduce just by saving for the future and just by making pension contributions. And imagine to what extent their bands could be extended. The band extension, imagine the range it could be extended to. So most of their income, if you mathematically think about it, most of their income would probably be taxed at 20% or worst case scenario 40%, just because they are rich and they have enough disposable income or enough income to save. Disposable income, for example, if for example my monthly expenses, household expenses and other expenses, for example, are 200,000 pounds, that's nothing for a good football player. Okay, the rest of it they're saving and they're investing in pensions. A chunk of it they're investing in pensions. Imagine how much benefit they'd get. A huge amount of benefit, right? This is where obviously the taxation system becomes unjust, because those who don't have enough to save, how would they extend their band? They're earning, right? For example, a family that's got 4 kids, the family is earning, let's say both parents are earning, the total earning, let's say even you say that for a month they're earning somewhere around, you can say 20,000 pounds or 30,000 pounds per month. But with 4 kids, you won't have enough to save and you won't have enough to contribute in the pension fund. Now, if you're earning 30,000 gross on a monthly basis, you're actually earning 360,000 pounds per annum. So you definitely fall in the additional rate band. You fall in the additional rate band, assuming that this becomes the taxable income as well. Now, obviously, just because you've got 4 kids, you won't have enough money to save or to invest in the pension fund. That probably allows you to extend your band or reduce your ANI. So you lose your personal allowance as well as a result. So if you don't put, if the government doesn't put restrictions on how much you could invest, or regardless of what you invest, you get a benefit on an X amount only, not more than that, then obviously the taxation system will become unjust. Okay. So therefore, the government has put in some restrictions and we will study those restrictions. The main topic is all about the restrictions that the government has put on the pension contributions so that the taxation system remains just and those who should be getting the benefit get it. Obviously, the rich, the cream doesn't need tax benefit. In fact, they're the ones who should be paying the highest amount of tax. Okay. So take down the notes that I've explained so far, and then we'll move on to the restrictions. If employer contributes, okay, exempt benefit for employee, that means the benefit will not be taxable. This is something that we will look at under employment income as well. Okay. And it's an allowed expense for the employer from its trading P&L. This is something that we look at in income from self-employment. That's a separate topic. Income from self-employment, and this is we look at in the employment income topic. And similarly, this is something we look at under employment income topic as well. Allowed expense for employee from employment P&L, right? So we don't need to focus on this right now. We'll look at it later on. Personal pension contribution. The same benefits if your employer contributes as was in the occupational pension plan. But obviously, if the individual contributes in his own personal pension contribution, personal pension fund, we already discussed what the benefits would be. And these 3 were the benefits, right? Now, the first restriction, listen to me very carefully. HMRC says that your pension will only attract, your pension contribution will only attract a relief of 20% contribution by HMRC and basic rate and high rate band extension and ANI reduction, the gross amount basically, right? The gross amount will be determined by something called the UK relevant earnings. That means if you contribute, if you make contributions out of your UK relevant earnings, it will count towards the benefit. Otherwise, there is no benefit. What are those UK relevant earnings? You either make contributions out of your employment income or your trading income, which is called self-employed income, or FHL, furnished holiday letting. Remember, furnished holiday letting is a type of property income. Those who've watched the lecture on property income, you'd know that furnished holiday letting is not, it's a type of property income basically, right? If you are making the contributions from any of these three UK relevant earnings, it will count toward the gross amount. And in fact, that will become the gross amount based on the formula over here. Okay. Now let's try to understand the formula. It says relief of gross PPC. Like I said, it will act as a gross amount. Is given lower of 1 and 2. Okay. So 1 is what? Total pensions paid, that is by employee in both occupational and personal pension fund, and individual in all pension funds, right? So this is a mistake over here. Just correct this in your notes as well. This is by employer. Okay, not employee, by employer. Okay, by employer in both occupational pension, personal pension fund, and individual in all personal pension funds, right? So total gross, or in fact, this is fine because they're talking about employee itself. Okay. Now that's one. So total gross pensions paid, how whatever amount that is, let's assume, let's take some numerical example over here. Let's say this is 25,000 pounds. Okay. The second one is what? Higher of two things, 3,600 and 100% of chargeable UK relevant earnings, not exempt for tax, but chargeable. Let's say 3,600, by the way, is the base limit. That's the minimum amount you will get. I'll tell you how it's minimum, right? So let's say your UK relevant earnings are 100,000, right? So in part 2, if you just look at this portion, right, you first have to calculate the higher of 3,600 and 100,000. So obviously the higher of would be 100,000, right? And lower of between 100,000 in this case, because that becomes the higher of over here. Okay. And 25,000, right? So I'll just change the color of the pen. 100,000 becomes the higher of, and 25,000. Obviously, which one is lower of? 25,000. So 25,000 becomes the gross amount in this situation. All right. That's number one. Number two, for example, what if your UK relevant earnings are just 1,800 pounds? What is higher of then? 3,600, right? So in this case, 3,600 is higher. And if you compare 3,600 with 25,000, which one is lower then? Obviously 3,600. Just because your UK relevant earnings are not enough to fund the 25,000 pension contributions, you will not get a relief on the entire 25. You will just get a relief of 3,600. What if, third case, what if your gross total pension contribution is 25,000 only? Okay. But your UK relevant earnings are, let's say, 15,000. So between 15,000 and 3,600, which one is higher off? Obviously 15,000. Now, once you've got the higher off, you have to take the lower off between the two. So obviously the lower off also turns out to be 15,000 between 25,000 and 15,000. So you see, despite you making the contributions up till 25,000, your gross contribution is 25,000, right? But it will still be restricted. The relief will be restricted. That means the gross amount will be just 15,000, because that's what your total UK relevant earnings are. Okay. So this is one restriction that applies. For example, if you're earning interest income and making contributions from that, if you're earning a high level of dividend income and you're making contributions from that, it won't count towards UK relevant earnings because simply because UK relevant earnings only includes employment income, trading income, and FHL. By the way, that does not mean that the law stops you from making a contribution. You can make as much contribution as you want from whatever income you want, dividend income, interest income, whatever kind of REIT income, for example, rental property income, for example. You can make contributions from whatever income you want as much as you want. This is just about the tax relief that you will get. The restriction is not on the contributions you make. The restriction is on the tax relief you will get on the contributions. Okay. That's restriction number one. Let's try to understand restriction number two. Okay. First, take down notes for this with the examples that I showed you. So for example, you can also work out your own examples if you want, assuming case number one. UK relevant earnings and pension that's a case number one. Number two, let's make this 60,000 and 8,000. Number three, let's make this 1,000 and 5,000. Okay. So just with the knowledge that you just got, try working out these examples and see what answers you get for the amount of relief. Amount of relief is basically the gross amount. Okay. Try this. See, the UK relevant earnings in case number one is 15,000, right? So case one, Conan is saying that's 15,000. All right, let's see. So UK relevant earnings is 15,000. So I write 15,000 over here. First, I'm going to take higher of these two things. Higher of 3,600 and 15,000 is what? It's 15,000, obviously, right? Since the answer for two is now 15,000, you compare one and two and you take the lower off because the law says lower off, right? You look at the pension contributions. Pension contributions are 25,000, right? So the answer to one is 25,000. Answer to two is 15,000. You take the lower of the two, which makes 15,000 as the answer, making this the amount of relief. Therefore, 15,000 for you. The UK relevant earnings become the lower off. Okay. Case number three. Sorry, case number two. You've got, I'll just raise this out. You've got UK relevant earnings of 60,000. So obviously, if you compare 60,000 and 3,600, 60,000 is higher off. And then you compare this with the pension contributions you have made. The pension contributions you've made are just 8,000. Okay. So lower off between 8,000, which is total gross pensions paid, and 60,000 would obviously be 8,000. Therefore, the amount of relief in case number two is 8,000. Okay. Case number three. Just a second. What answer? 3,600. That's correct. Why it's correct? Let's see. Your UK relevant earnings are just 1,000. So higher of between 3,600 and 1,000 would be 3,600, right? Your pension contributions are 5,000. So what you have to do is you have to take the lower of between the total gross pensions paid and 3,600, which is higher of the two. So in this case, your answer becomes 3,600. That means the maximum relief you can get of the band extension and ANI reduction is of 3,600. So case number 3, the answer would be 3,600. Okay. So this is how you basically solve questions like these. Obviously, like I said, you have to incorporate the UK relevant earnings, compare it with 3,600, take the higher of the two, and then compare whatever the higher of is with the gross pensions paid. And between that higher of amount and the gross pensions paid, you take the lower of, and that becomes your maximum gross amount of relief by which you will extend your band and you will reduce your ANI. Okay. Now that was restriction number 1. That is on UK relevant earnings. It's defined by its, you work it out according to the UK relevant earnings, right? The second restriction that you see is called the annual allowance. Now, this is a deterrent. This is a deterrent. See, the first one was basically decided how much band extension you'll get and how much ANI reduction you'll get. Obviously, it decided the gross amount. So the gross amount basically extends your band and reduces your ANI, right? The first restriction was, or it revolved around the gross amount, which would extend your band or reduce your ANI. Now the second restriction is such that if you contribute over and above the limit, you'll have to pay tax on it. I'll repeat. I'm going to explain the second restriction. Don't worry about it. But the second restriction is such that if you cross the threshold, whatever excess you have paid, whatever excess you've contributed in the pension fund will be taxed. How will it be taxed? Let's discuss that. Okay. Now, this restriction is called a restriction of annual allowance. Just like personal allowance, you have 12,570, right? You've got an annual allowance available just for pensions, Annual allowance means that, let's say you have made total contributions, because what does it say? Maximum amount on which pension relief, including individual or employer contribution in personal pension contribution and or occupational pension scheme. So that means 4 contributions we're talking about. What 4 contributions? I'll just open up Excel. Just give me a second. It will be easier to solve them. So there are 4 contributions they're talking about. They're saying number 1, employer contribution in occupational pension plan, employee contribution in occupational pension plan, employer contribution in personal pension plan of individual, and individual's own contribution in his own personal pension plan. So 4 contributions. The first 2 contributions are obviously in occupational pension plan, right? Let me just choose the width over here. Okay. And the last 2 contributions are basically in the personal pension plan. Okay. So you add all of them. Let's say this is 10,000. This is 5,000. This is 35,000. And let's say, by the way, remember, you always will take the gross amount. Okay. Gross amount means multiplied by 100 divided by 80. Okay. So let's say the net amount is 10,000, or let's call it 15,000, multiplied by 100 divided by 80. So that means the total contributions you've made in this year, total contributions that you've made in this year is 68,750. Done? Now comes the annual allowance. Please focus on the calculation because there's a tendency that you might get it wrong. Okay, so please focus. Total contribution is 68,750. In our example, this is case number 1. So I'll call this case number 1. All right. Done. Now, if you look at the law, okay, just a second. 21, 22. You're probably assuming what I'm doing over here. Obviously, I'm gonna explain to you, right? Every year, you get an annual allowance of 40,000. Okay. If you look at this, if you look at the law over here, every year you get annual allowance of 40,000. Now, whatever annual allowance you have for 21, 22, it's 40,000 pounds. If it stays unused, listen to me very carefully. If this annual allowance stays unused, now whatever percentage of unused annual allowance that is, for example, in 2021, 22, you made a contribution of just 10,000. So obviously the unused annual allowance would be 30,000, the balance, right? This can be carried forward up till 3 years. You can carry it forward up till 3 years after, if you use it, if you, let's say, if you use 21, 22 annual allowance within these 3 years, good for you. Okay. But if you're not able to use it within 3 years, it expires and it goes to waste. It expires and it goes to waste. Okay. Obviously, for example, if this is 21, 22 fiscal year, this would be 22, 23. This will be 23, 24, and this will be 24, 25, right? These are the fiscal years. Obviously, in these fiscal years, you'll have the annual allowance for these years itself, right? Plus the annual allowance which is being brought forward from previous years. So if I make 21, 22 as the benchmark year, listen to me carefully. If I make year 21, 22 fiscal year as the benchmark year, this is how it's going to be. 21, 22 itself, 40,000 is available. This is to be used first. But if you go 3 years back, you start from 18, 19, then 19, 20 fiscal year, and then 20, 21 fiscal year, because after that comes 21, 22. The first priority is given to the current year. And then if you have excess, for example, look at this. If I utilize the annual allowance of 21, 22, which is 40,000, will I have excess? Yes, I'll still have excess, right? I'll still have excess of 28,750. Question: do I have any brought forward annual allowances from the last 3 years? Any of it? Okay. Let's assume I have. If you have that, you will use it on FIFO basis, first in, first out. That means the oldest year will be utilized first. Why? Because this is about to expire. For 18-19, for the fiscal year 18-19, this is the last year. 21-22 fiscal year is the last year. After that, if there is any remaining annual allowance from the year 18-19, that is 3 years back, it will go to waste. So it's better that you utilize it right away, because for 19-20, you still have 1 more year. For 2021, you still have 2 more years for it to expire. But for 18, 19, this is the last year. It's going to expire after that. So if you have any remaining annual allowance from 18, 19, utilize it right now. But like I said, the preference is always given to the current year first. Okay. Assuming, let's work it out. Let's say each year I've just got 1,000 available. Each year I've just got 1,000 available. That means I've still got some excess remaining. Do you agree? I've still got some excess contribution. I've still got some excess contribution remaining, which is 25,750. Please focus. Okay. 25,750 is the excess contribution which is remaining. I want you guys to please focus over here. This 25,750, okay, will be taxed as the last source of income. That is at the highest rate. What does this mean? Taxed as the last source of income that is at the highest rate. How many sources have we determined earlier? Non-savings, savings, and dividend. For those who have revised, you'd be able to recall there were three sources: non-savings, savings, and dividend, right? Once you have taxed all the sources, you've taxed non-savings, you've taxed savings, and you've taxed dividend. Once you've calculated the income tax liability and you've calculated tax on everything, that is when tax on excess pension contribution comes in. So imagine the level of deterrent it creates. Okay. So the level of deterrent is extremely high. Tax on excess pension contribution comes after you have taxed non-savings. It comes after you've taxed non-savings, savings, and dividend. And you've calculated the income tax liability, and after that you tax the pension contribution, excess pension contribution. Now remember, excess, it's not always the case that you'll have an excess. For example, let's say you had enough annual allowance to cater, let's say you had 20,000 available from this, you had 5,000 or let's say 15,000 available from this, and you don't even need this, right? Obviously, you cannot have a negative excess contribution. The excess contribution becomes zero. In that case, you won't have any tax. In that case, you won't have any excess pension contribution tax. Okay. But if it's a positive figure, right, you will tax it. And this will consume the band. But like I said, at the highest rate. Highest rate means after non-savings, savings, dividend, all incomes have been taxed the way I've taught you in the first few lectures. Once you've taxed everything, that is when you tax the excess contribution, just the same way. By the way, remember one thing. We have looked at two different rates, normal rate and dividend rate. Taxed as the last source of income at the highest rate using the normal rates. So that is 20%, obviously 40% and 45%, depending on where it lies. Okay. So please take your notes on this. Note this down, and then we'll move on.